Well, I think the creditors have taken something of a haircut in this process, unlike a lot of us in lockdown. But I think the key things are, first of all, Bain has got deep pockets, which is going to be necessary. Secondly, I think they've got the model pretty much right, which is pitching it somewhere between Qantas Group's Jetstar and Qantas itself, full service carrier. It's an interesting sort of not low cost, but what you call value airline in the future.
So how is it going to play into that gap? How do you increase the customers' willingness to pay here if they pivot the airline from what was originally going to be this full-service international airline to be a more domestic carrier now? How do you increase willingness to pay if you're going to be between that gap of Qantas and Jetstar?
Well, it was predominantly a domestic carrier before, and the domestic market is the one that's going to come back first. I should have said too, of course, in the process of the Bain buyout, they've also dropped the Tiger low-cost airline subsidiary, which was there to compete directly with Jetstar. Yeah, so it's a good question. How can they compete in that market? I think what you're going to see is an airline which is going to go for the business market, but it's going to go for probably a much more price-sensitive business market, with a standard fleet of 737 aircraft, which don't have the lie flats of its previous A330s for domestic operations. So it's very much a sort of budget business class, but also with a much lower cost base, attempting to attract a lot of the passengers that will go otherwise to Jetstar.